In this video, I'm going to walk you through how I turned a losing $800 position trade into a current winner where I can close out the position for around a $50, $60 profit. So we're going to go through the anatomy of how this trade build. We've got it for the people that like numbers. We've also got this visually so you can see what happened to my put strike, call strike over time, all that kind of good stuff. And all I ask for is that you smash that like button and don't forget to subscribe. Now, what you guys can see in front of you is my kind of put strangle spreadsheet that I use to track individual positions. And I'm not going to go into this in a lot of detail. I just really want to talk about the content in terms of my Google position that I had on. But if you guys want to learn more or understand where you can get the spreadsheet, drop a comment down below and I'll do a dedicated video about this overall strangle calculator. So what we have here is obviously Google's current stock price and the date today or the day I'm shooting this kind of video. And this all kind of helps with the calculation of how I manage positions at 21 DTE and all these kind of good things. But the key thing I'm going to walk you guys through is at the start, how this trade started. Then we'll look at the visual in terms of a graph view of over time, what happened to my strikes, what happened to my premium, all this kind of good stuff. So I opened this trade and I'm still in this trade. So it's the 6th of October today. I opened this trade on the 8th of November this year. And I originally started with a standard naked put option, $89 put option there. And we'll go into what the current price was and all these kind of good things in a second. But I opened the trade for $125 premium. I'm just going to ignore commissions for now from there. And what happened is that the price started to go against me where my put got tested. So what I decided to do was open up a call to make the position into a strangle. Now, the reason why you want to do this when your put side gets tested is really for two reasons. One is that it gives you the flexibility of moving around your strikes and using the other side's premium to be able to do that. So again, you can start rolling positions to put your current position in a better area for a net credit. And again, the visual will show you this. And then secondly, you want to sell the other side because it doesn't take any more buying power to open the call side of the trade. Now, so I'm not going to go through all of these trades, but you can see here, I've done a lot of adjustments in this overall position. And how I adjust trades, again, I've done a number of videos on how I stay mechanical when things go wrong. And what I try to do on this channel is show you guys when things go wrong, this is how you get out of trouble. So if we go back to, if you sell a 20 delta strangle, you have an 80% chance of being right. An 80% chance you will be right. It's that 20% that I'm trying to teach you guys on how to stay mechanical and make those 20%, in this example, make it into a winner. So what we did a number of adjustments here, rolling at 21 DTE, rolling up and down the untested side, all of these good things. And what you're seeing here is the initial trade, I made $125 premium. And then throughout all of these rolls and adjustments, I've made an additional $1,300 across the 8 months or whatever it is. And I've been trading one contract, trading small. And you can see here currently, this is the kind of viewpoint as of right now, is I've made $1,400 in the overall trade, and that is the initial premium plus the additionals. All this will be all net of commissions. And I have a realized P&L of $254, which is all good. My current position is the 130 straddle, which you can see here, which is what I have. And the current price is obviously 137, nearly 138. My call is 6% in the money and my put is 6% out the money, which again is fine. The next adjustment could potentially be is rolling up my put strike to the 135, but I'll show you why I haven't done that as of yet. And this just gives you some information in terms of how I was to close the position. Can I close it out inside a profit? And we'll touch on that. But the key thing I want you to take away from this is I've taken the loser, and this has got my realized P&L on here. So if I look at the realized P&L at some of its low points, you can see here that the sum, my realized P&L, which currently sits at 254, I had realized losses here of $752, which if you look at it against your current premium, that's just under a 7x loss. But I don't take losses, I adjust, I pick up premium, I make adjustments to my overall position. So again, if you want to learn how to mechanically do this, again, I strongly encourage you to watch my other videos. If you want one-to-one coaching to go through this in a lot more detail, again, click the join button or the pinned comment down below. Now, the bit I want to show you guys is how this looks visually on the chart over time since the beginning. So there's a lot of lines here. So the gray line is Google's price. And you can see Google has basically been going up, which if you think about what I originally did was sell a put at the beginning. If I didn't do anything, the put would have just expired worthless and wouldn't be in this situation, but that's all good. Let's not worry about that. At the time of when my put strike over here was being challenged, you can see here that I opened the call strike. And so the red line is the put and the blue line is the call. Now you can see here where I get into trouble is where it whipsaws me. So again, if I did nothing, I would have been okay. I had to manage my risk, manage my deltas. I didn't know that Google was going to go all the way up. It could have gone all the way down. What I did here is we open the call and you can see here Google goes and hits my call strike. When that happens, I'm rolling my put side up. So you can see here, as I get tested and I'm rolling out at 21 days, I'm trying to increase out my call strikes getting tested. I'm rolling up my put. And again, I'm doing all of these for net credits. And what you're gradually seeing are these blue dotted lines, which is my break-even point. So it's the total premium that I've collected by doing all of these adjustments that get added on to the call side and minus from the put side to give you your break-even point. And we get to a point of where we're finally at a straddle position in this overall thing where, again, I'm way in the money on my call side. So I had to very aggressively bring my put up here. And then again, we are at a point now over here where the put strike is greater than the call strike, which basically means we're inverted. So at this point here, I've got a classic naked put. We're in a strangle. We're now at a straddle position, and we're now have an inverted strangle when my put is higher than the call. And what's interesting, you can still see here, you got your blue break even and your green break even. And as you can see, I'm quite close here to my break even. And then the stop goes down slightly. And then I go back into a straddle, back into a very small strangle, back into a straddle again, then a strangle, and then a straddle, inversion, and then the straddle. So again, a lot of adjustments, which again, they're all outlined here, all of these adjustments. This is how it visually looks over time. But again, as you can see, that the blue line and the red line are getting bigger and bigger. As I generate this 1,355 and rolling for net credits, you can see now here, where we are now, we're at the 130 straddle. As we talked about before, we're at the 130 straddle, which is this area here. Price is at 136, 137 over when I took the latest pricing. And now you can see that my break-even points are very wide at, 144 and at 115 with the price at 137. At the moment, I'm sitting, my call strike is breached, my put strike is fine, but I've got such a wide position here that I don't really need to do anything. And as I said before, the right move, if I had a smaller break even, was to move my put strike up to the 135, but I've decided not to do this as of yet because I have such a wide break even. Now, the cool thing is I took a screenshot of the current position, and these are the last prices of these options if I were to buy these back. So if I was to buy back the put, which obviously is going to be less because it's out the money and is losing value as Google is going up, I can buy that back for 251. I can buy back the call, which has gained money today because Google has gone up, which again is going against my overall position. I can buy it back for around 1,100, and therefore we got just under $1,400 to buy this strangle back. I've collected $1,435 in this overall trade. So I can actually walk away for a trade that I've been in since the 2nd of February for $59. Now, that just shows how staying mechanical But when we had a 800-ish loser over here, or 700 as it kind of nets out to be up $59. And this is the power of trading naked options, especially strangled. You've got so much flexibility here, and it might sound daunting that you go inverted and do all this type of stuff, but hopefully this visual diagram shows you, as the price has gone against you, we've gone from, what's the price now? 137 to 90. 137, so that's $47. 47 divided by 90-ish. It's a 52% move, right? In 8 months, Google has done a 52% move into the upside, and I've stayed mechanical to be able to manage this position. So I could get out of this trade, and that's probably the right thing to do. But because I've got such a wide break even, I'm not that far away from my current strikes. I feel like I should be able to get at least 25 to 30% of this 1,400 number. I'm thinking around $300-400 I should be getting on this trade, because I built up all of this premium. As long as it stays around here, and 140 would be the kind of point where I would roll my put up to 135 to pick up some more credit and widen out that break even further. The other bit I need to consider is earnings. Google will have earnings in the next cycle, that when I roll at 21 days. So again, that will factor into my decision-making process of how long I keep this overall position. So I really hope you've enjoyed this video, of more of a visual kind of view of managing losers and how to turn them into winners. And the bit I really want you guys to take away from this is, it's not that hard, right? Yes, there's a bit of a learning curve to understand deltas and inversion and when to roll, when not to roll. And again, there are mechanics in place to tell you what to do, when to do it. And I think you guys will benefit from subscribing, looking at my other videos. And again, if you are interested in getting some more personalized coaching from me, click the join button down below, which is also the first link inside the description. And I'll walk you through all of this. I'll walk you through how to do this. And again, if you've got any questions, you can drop me an email and we'll go from there. So really appreciate that. Like, subscribe, comment down below, and I shall see you guys in the next video.